2025 has been a banner year for investors in emerging market and other non-US asset classes. We think that strong performance in global markets continues next year. That does not necessarily preclude the scenario of US stocks continuing to do well on the back of AI enthusiasm, but there looks to be plenty of reasons why investors could benefit from increased allocations outside of the US. A key part of the story is that profits forecast for next year show a coming together. So if that's right, and we get a broadly positive macro backdrop and further global rate cuts, then there is a case for a further broadening out of performance into areas of markets that have historically lagged, such as emerging markets, Europe, and Japan. Meanwhile, in credits, with spreads being very tight, the market looks priced for perfection. Defaults are rising, but corporate balance sheets and credit fundamentals look good. And we don't expect a recession in our base case. So the risk is more that AI/tech/data center related issuance creates some spread widening, a so-called crowding out. So we take a quality focus, a strategy that has not really worked since the GFC, but could come back into favor. And against the backdrop of idiosyncratic credit events, we think bottom-up, detailed credit research will be key in 2026. Looking at the US right now, it's difficult to deny that the market outlook is supported by AI and the strong revenue generation potential that brings with it. But there are some big questions around mega cap tech valuations now, and there are some big questions around the ROI on the capex spend, as well as the circularity of the financing. The broadening out idea reflects that the opportunities in the global technology sector, in Asia, China, or India tech, for example, could be just as profitable and with less valuation risk for investors. In particular, China's burgeoning tech sector can continue to catalyze investor interest, with ongoing research and innovation, including around AI, potentially making US tech less dominant in 2026 and beyond. Broadening out also means how the AI investment boom isn't just a tech play, but can spill over into other sectors, into utilities, power generation evidently, construction, healthcare, basic materials, and so on. And lift the performance of some of these other sectors which have historically not done so well. So market dynamics become less about tech. And other stock market weighting schemes, equal weight or the S&P 493, for example, have a chance to perform. And it's really interesting that US stocks outside of the tech sector remain at wide valuation discounts. Same too for EFI and EM stocks, really, even after this year's strong performance. By itself, that's not a guarantee of success, but it does emphasize that these assets have room to run as long as the right catalysts are in place, which we think they are. A key question then is how much of the good performance in EM has been because of luck or because EM is good? Lucky because of the weaker dollar boosting up performance? Or good because years after years of macro reforms and more developed financial markets having an effect to de-risk emerging markets? In reality, the answer is probably a bit of both. A weaker dollar has clearly helped performance in emerging markets. We know that it loosens financial conditions for EMs and encourages capital to flow downhill. The good news is there is room for further gradual falls given ongoing Fed cuts, evidence the currency is still overvalued, and has perhaps lost some of its status as a key haven asset. As investors hedge against potential dollar weakness in global portfolios, this should also put downward pressure on the currency. But macro de-risking has been a big achievement too, reflected in EM asset classes, showing lower volatility than developed markets. This is a very important change, but it would also be naive not to recognize some of the challenges for emerging markets in 2026. China is still exposed to deflation. We have the longest stretch of deflation readings in China since the Asia financial crisis. So we are looking for policy support and maybe some of the fiscal measures emphasizing consumption from the recent 5-year plan to help with that. Secondly, we also have trade risks. Tariffs have dropped off the radar for investors a bit recently, and we've seen more of a regionalization in Asia trade flows, for example. But 2026 will be a busy year for geopolitics, so we'll need to watch that closely. And finally, investors will want to see that the expected strong GDP growth and profit rates are being delivered to. And what the complex macro and policy environment brings is also the likelihood of significant country-by-country divergence in growth and stock market performance. This is based on varying exposure to global trade and differences in fiscal, monetary, and industrial policy settings. Overall, this suggests that in 2026, an active approach to EM allocation has legs.